Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello everyone, my name is Aleksandra Palinska and I am the Executive Director of Eurosif, the European Sustainable Investment Forum. For this episode of Sustainability Bridges, I am honored to be joined by Ms. Hadewych Kuiper, Managing Director of Triodos Investment Management and board member of the Dutch Advisory Board on Impact Investing. Together, we are going to discuss the Corporate Sustainability Due Diligence Directive, the so-called CSDDD, and the review of the Sustainable Finance Disclosure Regulation, known as SFDR. Dear Hadewych, thank you very much for joining us today.
Thank you, Aleksandra.
The European Corporate Sustainability Due Diligence Directive, which aims to establish due diligence rules for the largest European companies to identify and address the adverse effects of their operations on the environment and human rights across the value chain, is currently in its final stages of negotiations between the European Commission and the European Parliament and the Council. Are you in favor of mandatory due diligence for all large companies? Do you believe financial institutions should be included in the scope?
Well, thank you for the question, and it's a big yes. We're very much in favor of this, and this has always been our position since the proposal came to the table. So the regulation would have actually a very wide scope and include financial institutions. Why? We believe it's relevant for all companies. All businesses should know what their negative impacts are on the environment, on people, how they're acting. And not only knowing, but actually also acting upon it, right? Reducing it and managing the, seeing if they get the negative impacts lower and or even eventually stop them. But with them bringing up new regulation, we do believe it should be within the guidelines that are already there. So we liked that it's sort of in line with what's already very well accepted and in best practices like the OECD guidelines, to the United Nations guiding principles on human rights. So that would make sense for everyone. The financial sector is a must-have to include, according to our opinion. You know, financial institutions, they really play an important role in the transitions that we want in society. So they need to be aware of these negative impacts. If we ruin the planet, if we ruin human rights, that's really at the core of what they're at. And they are the providers of the funding, of the investments in order to actually get the capital to the type of companies that are part of the transition. So yes, for us, the financial sector for sure needs to be part of it.
Thank you, Hadewych. Could you share with the listeners how can financial institutions, in particular asset management firms and banks, effectively perform environmental and human rights due diligence? And what are the related opportunities?
Yeah, so like I said, the financial institutions are really the providers of funding, and in that sense, key drivers for the change towards those transitions. But financial institutions need to be aware of the impacts of all their clients, whether it's business lending clients, investees they invest in, and they need to know who they're lending to and what they invest in, simply from even a risk-based perspective, right? What are these companies doing to the planet? What are they doing to human rights? Financial institutions need to know and need to understand because they take the risks basically in their portfolio by doing the investment. So without that, they cannot even do their proper risk management. So for me, it's very basic. But the question is how? And well, I can share what we do. So for every investment decision that we take, we do our homework on this part, basically mapping the risks and asking our companies, are you aware of the negative effects that your products and services may have the procedures and how you operate. So not only what you're doing, but also how you're acting as a company. Are you aware of that? Are you, if there are negative effects, are you managing that? Do you have policies on it? Are you actually mitigating those? Because for us, those are risks. And in doing our diligence, our homework on these companies, we of course focus on in sectors or certain clients where certain risks are more relevant than others. So yes, you can differentiate and don't have to do everything for every client. By the way, the OECD has published guideline documents for doing that. So very detailed guidelines outlining how you do this sustainability due diligence. So that's available and for all different type of investments and different type of financial institutions, whether you're a bank or an asset manager, guidance is available. So we do that homework. If our due diligence shows there are indications that the client is breaching human rights or really their products are polluting rivers or a certain area, if that's the case, financing should not take place. So it should be really embedded in your processes that you're not financing that. In most of the cases, engagement comes in here because we might not be fully assured in the way the company is doing it and if they really understand it. So we basically start a dialogue. We do that already before investment. And yes, that all takes time, but it's crucial for our risk management. So we have that engagement before starting the investment if we're convinced investment can take place. But also after that, during the relationship with our investee or lending clients, we continue our engagement during the monitoring. So we also want to make sure that they don't do more or different harm when we have provided the financing. So that's how we do it. I think, like I said, guidance is available. Are there opportunities, you asked? I think at Triodos, yeah, we are a we call values-driven financial institution. So we make very deliberate choices how we allocate the capital. We want to do the right thing. We want to contribute the capital to those companies that actually do not do harm, but also actually accelerate the transitions in society. But I guess even if that's not your first driver as a financial institution, doing this type of due diligence really helps you also to avoid being associated with harm, right? Avoid having negative reputational effects. So yes, for us, it's in our DNA, it's how we look at investments, but I firmly believe it considerably lowers the financial risk we have in our portfolio and the non-financial risk. So being involved with clients that cross social or environmental externalities is not what you want to have in your portfolio. And yeah, I think also in the ECB, the Dutch Frank Elderson has also acknowledged that again, that due diligence, sustainability due diligence is really a key component of your risk management or of your sustainability risk management, if you like. So yes, enough opportunities, and that's how we do it.
Excellent. Thank you so much, Hadewych. This is very insightful. And I think you're very right to pinpoint that at the end of the day, even though the name refers here of the directive to the due diligence, but in reality, it's not only about doing good or better being aware of and then managing any adverse impacts, but eventually about just proper risk management, right? And being more aware also of the sustainability risks, and being also mindful that in reality the double materiality is based on the assumption that the impacts may become also eventually sustainability risks.
For sure. So you have to look at both sides. And as you say, it's sometimes I think it's so common sense, and also for financials, because risk management is their core business. And I think it's more a matter of actually embedding it in your processes and doing it very explicitly. And therefore, the regulation does help to basically, make it mandatory. But it should happen anyways, for sure.
Excellent. Thank you. Now, let's speak about Article 15, which aims to require all large companies to set transition plans, including climate targets. Here, the position of the European Parliament and the Council differ, with the European Parliament wanting to ensure such plans are adopted and implemented. Do you see this as an important requirement? And do you think a requirement to set the target without an explicit obligation to implement it would be effective?
Yeah, I guess you will not be surprised by my answer as yes, we believe it's absolutely necessary. And for us, it's really a crucial requirement that should be in. It's also fully in line with, let's say, the main notion of why we do this sustainability due diligence, which is really to be aware of these negative impacts on planet, on environment, but also on people, and act on it. And the acting part, that's what now is needed. So yes, you need to do your due diligence, you need to be aware of it, take mitigating measures. And that final part, that actually acting on it, that's where this Article 15 comes in. So yes, we believe it's absolutely necessary. Without that obligation to actually implement it, it would not really add anything to what's already being provided in other regulation. I think it can actually help with the current problem we have, that so many companies have done pledges toward net zero, have done pledges about their wanting to reduce their emissions, but it's all very late, mostly 2050. Us as an institution, we have stated 2035. It's very ambitious and very soon, and we are a bit scared about it, but we felt it's needed. But all these pledges and being so late without any obligation that they will be implemented is a true problem. If we would count all the pledges, we would already have solved the problem. And we all know that that's not the case. So there need to be transition plans. Also here, you could argue it's also part of greenwashing, having a transition plan but no obligation to implement. So we need to avoid that. And I actually think this is only for the larger companies, right? So also for them, it would help to reduce the risk of them being exposed to also greenwashing allegations and procedures coming up in litigation. So it should definitely be in. We're in favor of it.
Great, thank you. Some business organizations continue to express their concerns about making directors responsible for setting and implementing climate targets, fearing potential implications, even lawsuits. Do you think this is a valid concern?
I do understand their concerns, but hey, as a director, you're responsible for the activities of your company, right? You have a duty of care for the continuity of your company. You have a duty of care to act in the best interest of the continuity of your company. So yeah, if you look at that, it's really part of it. If you need to be considered about the long-term viability of your company, then in many cases that would not be possible without an effective climate plan or an effective transition plan. So I do understand the concern. I'm told by my legal advisors that the fear of lawsuits is a bit overblown, that corporate law in the EU does allow considerable margin for directors. So, but only if you take the transition plan seriously, right? If as a board you have a transition target or a plan, but you're not implementing it, you're not acting in the best interest of the company. For sure, you will be, or you will have problems with that. So I think another element, but that's more for the outside world or for the company itself, making board members responsible and actually hold them accountable would also make sure that we have this saying of a clear tone of the top that's so essential to actually make the company move and make all the co-workers of the company move. So also for that reason, I think it should be in.
Great, thank you. And I think it's really important what you said also about the right tone at the top. And I think something that is often forgotten is that originally this was supposed to be a directive on sustainable corporate governance. and
Yeah.
that actually integration of sustainability risks and consideration of adverse impacts was supposed to be front and center of it, also in terms of including it within the corporate strategies, right? Because at the end of the day, what's the point of having, a separate kind of officer dealing with corporate social responsibility or whatever else you want to call it, if this is not kind of properly integrated within the company's main strategy. And I think here, even though that there are so fears about some of those provisions, at the end of the day, it's, as you said, I think, about common sense, proper risk management, and basically just kind of ensuring that these matters are debated uh, within the boards.
Yeah, for sure. And if directors don't see it, their supervisory board members certainly will. If you look at what's in the programs of corporate governance trainings and education, this whole sustainability from a risk management point of view is center stage, and it's something that also supervisory board need to get more familiar with, becoming better in asking the right questions. And from a risk management and common sense point of view, that's perfectly fine, and they know what to do. So if you do it only for risk management, fine for me. We have also another drive for doing it, because we really believe this is what financial institutions should do in general, and they participate in society, in the economy. What they finance, yes or no, really makes a difference over time. But no, I think it's really part of the duty of care, and if they're not there yet, their supervisory board members certainly will make them think about it also.
Thank you. What are your views about the provision aiming to set a behavioral incentive by linking a proportion of directors' variable remuneration with climate targets?
Yeah, you can hardly be against it, right? In general, I'm very in favor of putting sustainability performance and financial performance more equal. And financial performance, we all know how to do it. Sustainability performance, or non-financial performance, if you like, that should get more attention. As Triodos, we do have a dilemma here. We don't do bonuses, so we don't allow for any performance-based incentives. We believe, and history has shown, there's a big risk of perverse incentives of having bonuses, particularly if you only link them to financial targets, you only link them short term and to only individuals. So that's not what we do. And there is this sort of ethical consideration that I find it very awkward as a director that you should receive a bonus for simply not doing harm to the environment. That is, I think in the financial industry, really, we need to get back to common sense. And I think European regulator perfectly understands that. But if it's not making sense for normal people, and it does not make sense to give someone a bonus for simply not doing harm, so that's more of an ethical consideration. So all in all, as Triodos, our stance is that we prefer that these incentives are more on a voluntary basis and are being disclosed. That would really help, but not mandatory. That would put us in a difficult position.
Sure. I mean, thank you for sharing that. And I think here the Triodos model is a very interesting one. And I couldn't agree more that I think big part of the problem, I would say, among various companies right now is that, looking at the bonuses, right? In some cases, they can indeed set certain perverse incentives, and in a way, I think this is what this aims to kind of balance out. But I can definitely also understand your rationale, and indeed, I think companies also should be free not to basically set any bonuses, right? And I think you have a very good point here. Now, moving on to the next question related still to this topic. Should due diligence requirements, in your view, cover both upstream and downstream value chain for financial institutions? And if yes, to what extent?
Yeah, particularly for financial institutions, right? Because in general, I think it should cover both upstream and downstream value chain if we do due diligence. So in general, yes, but I do believe in this case there is reason to make a distinction for financial institutions, and upstream should be covered also for financials, but I think it's fair to also point out that's not where the material impact is. For a financial institution, clearly it's in their portfolio. So really downstream is the most important part of their impact, both positive, but in this case where the negative impact may be. So it should, I think for financial institutions, it's more important that it covers all their clients and we don't make exceptions. It should really cover everything they do, even if they are also partly an asset manager, that's all included, the whole loan book, etc. As long as it's to businesses, I don't think this regulation is meant for private services. It's really to business. So I do see that difference for financials, that it's more relevant to go downstream in the value chain.
Thank you. To conclude this topic, what would be your main recommendations to both EU policymakers and also financial institutions on this very topic?
Yeah, I think we covered a lot, and the main thing would be do include financial institutions. That's really very important, and leaving the financial sector out of scope, that would seriously undermine this regulation and also what it's trying to achieve, right? As part of the complete sustainable finance action plan. And at the end of the day, we want to get rid of the systemic risk, but also we want to have more capital flow to sustainable companies that actually contribute and not do harm. And financial institutions are key in that transition. So that would be my main recommendation if I had to choose one.
Thank you. Let's move on to the Sustainable Finance Disclosure Regulation, so-called SFDR, effective March 2023. It was one of the first regulatory initiatives stemming from the 2018 EU Sustainable Finance Action Plan. Together with the EU taxonomy, SFDR creates a new sustainability-related disclosure framework for financial market participants and financial advisors, with regards to the integration of sustainability risks and the consideration of adverse sustainability impacts in investment processes. Disclosures comprise entity-level and product-level disclosures, including on the integration of sustainability risks into investment decisions and/or advice, and whether, and if so, how they consider the principal adverse impacts or negative externalities of their investment decisions on the environment and society. SFDR has been heavily criticized by the financial industry, and some of it's well-funded, insufficient clarity of its definitions and purpose, transparency regime versus labeling regime, insufficient or lack of criteria, complexity. However, it has been also, the very first sustainability-related transparency regime of this sort worldwide. Moreover, it was the first regulation that abandoned double materiality in the EU law, and despite some hiccups, it has improved transparency on sustainability-related considerations in the financial markets. What is your experience with SFDR? What are, in your view, the main achievements of this regulation, and what needs to be improved in the context of the forthcoming holistic review?
Yeah, that's quite a lot on SFDR, right? What we had to implement, it's quite extensive. I think that's the first and foremost experience. But more important, I agree what you just stated. It's the first regulation ever, right? Everyone is following Europe in this sense, and I would agree. We called it a big game changer, and I think it deserves that title and also appraisal. And maybe a bit of context, but at Triodos, we have been active in impact investing. We have been having this screening in our investment process for over 30 years. And we can see that the regulation has had a big, this game changer effect on actually mainstreaming sustainable finance into the financial sector. So I think that's a big achievement. And I've said earlier, Paris Agreement, right, back in 2015, that brought really sustainable finance to the stage. That financial sector had a role to play. But I would say that the SFDR had really brought sustainable finance into the boardroom of every financial institution. So that's a big achievement. It's also true we have complained a lot, and it was not always easy, and there's a lot of unclarity. That's also true, but I think the bigger picture is that it's a major achievement. So that would be first. Second, we're not there yet. I think that's also fair to state. The goals have not been achieved yet, right? Transparency, maybe yes, but shifting the flows of capital to more sustainable companies, helping all investors making more informed choices, that's not really the case. And what I find particularly disappointing, that we have all been busy in not really doing more sustainable investments, but recategorizing what we are doing in this framework. And the whole purpose is that we move towards more sustainable investments and really take that into consideration in every investment decision. So we're not there yet. Another important experience on our side that we see one big flaw still, and that needs to be also reviewed, is that the disclosure regulation targets only sustainable funds. So within the current SFDR, it's the sustainable funds need to disclose, the non-sustainable funds do not need to disclose. And I think you can only make an informed investment decision, like the previous regulation, if you also see the negative impacts on environment, on people. So we think that the PI statements, the principal adverse indicators of the indicators of adverse impact, need to be mandatory for all funds. And I often use this metaphor about an apple and a package of cigarettes, that the sustainable funds, the apple, before they can be sold on the market, they need a full list of indicators and disclosures, both positive and negative. Whereas a package of cigarettes, the non-sustainable fund, can basically go to market without any disclosure. And we feel that's not helpful for investors to make an informed choice. You cannot compare, and it's definitely not helpful for an equal level playing field. So that's the big flaw. So we would like to see in the new or in the reviewed version that the regulations are being mandatory for all products, and whether you call yourself sustainable or not sustainable, just disclose.
Yeah, I think that's a very interesting point, and we have been also, discussing quite a lot with our members within the working groups, and indeed we are considering to make a suggestion to consider disclosures, some minimum level of disclosures across the board, right? So basically for all funds.
Yeah.
At the same time, touching upon a little bit the discussion of that, SFDR, well, I mean, from the legal perspective, is a disclosure-based regulation. However, it's kind of, it went sort of one step forward towards actually becoming some form of a standard or labeling regime. And now, obviously, also the elephant in the room is, and frequently discussed question, okay, is it now worthwhile to take the opportunity of the forthcoming review to transform it into a fully fledged standard for sustainability related investments, which indeed, could also comprise, a set of kind of disclosures, for all funds, including, on possibly significant harm, right? But at the same time, retain the categories, but maybe try to see, whether there are adjustments needed, and indeed differentiate between sustainable investments, so investments into what can be already considered sustainable or in the environmental context green. But then, as you rightly pointed out, I think a lot of criticism has been also that currently none of the, I would say here, categories, well, basically cater for the specificities of impact investment or transition finance. So then maybe considering creation of a kind of a dedicated impact / transition investment category, or for instance, what in the UK regime they're referring to improvers, and then maybe yet still having, another category. I mean, transforming the current Article 8, so products with ESG characteristics, but, kind of include some better, I would say, definitions, robust criteria, but at the same time, still, I would say, having a category which maybe is not necessarily as ambitious as sustainable investments and transition finance, and could still cater for some other sustainability related investment approaches, and in a way then differentiating it from investments that don't consider ESG at all. What are your views on that?
Yeah, that's very much in the line of what we're proposing. So in the consultation now being out there, our position is indeed but then to support a full-fledged classification system. So be very clear, yes, it's labeling, and that helps investors to choose and to make better informed decisions. And we know from, behavioral research, it needs to be very clear and simple for investors. We also always include we have a strong eye for retail investors. At the end of the day, we want the citizens of Europe to invest their money more sustainably and being included in all of this. Because more professional investors, they have their analysts and they look into all the disclosures and they do all the work. We have a completely new group of professionals in our industry reading PI statements and reading all the disclosures. But at the end of the day, it needs to be understood by all investors. And we believe that a full-fledged classification system would help with very simple indicators for the sustainability performance. Indeed, including, so it can be a label or anything like a stamp of approval, but easy to understand, easier to understand than now the long and extensive disclosures about investment strategies and exclusions and engagement and all the variety and very qualitative way of approaching it. We believe it should be done in a way that it can be more easily benchmarked. So the outcomes, just a number doesn't tell you that much. People also find it hard to, if you hear about the emissions avoided or emissions, clean energy generated, how much is it? So you better benchmark it. So you help investors to easily compare similar products. So we would like to see to move that full classification system, and we have done a proposal on a scale of 7, where in the end the scale of 7 or 6 and 5, they're more closely to the current Article 9. They can differ in the percentages of sustainable objective, and the number 1 is clearly stating that no sustainability considerations are in the investment strategy. So, and then you have a few in the middle that are closer to Article 8, but better defined in their strategy what they're doing. So there would be room for everyone, but it's more easily to compare for investors. So it has been used by a label. We know from our experience that's also what our clients ask us. Is this Article 9? How is it? They want to see it on the information. We're being held back by regulators that we can communicate it. We cannot communicate it as a label. So it's really weird. Everyone wants to know, are you Article 8 or 9? And of course we say it, but they really have to search for it sometimes because we cannot use it as a label. And that's not helpful. So we have a full list of ideas and improvements that we're sharing at the moment. And happy to share with everyone involved, the more the better, to see if we can help to move it in the right direction.
Great, thank you. And actually, maybe just touching upon what you mentioned actually about the scale, because this is also quite an interesting topic. Do you think it's possible, for instance, to easily benchmark or compare products which might be composed, I would say, of different types of assets, and also, for instance, using quite different sustainability related approaches and investment strategies, right? So I think part of, I would say, the challenges that also the financial industry has been faced with is looking at what traditionally has been, I would say, used in terms of investment strategies within the kind of the ESG landscape, like for instance thematic investments, positive screening, negative screening, then also, obviously, the impact investment is then very specific. But yes, I mean, ESG integration, some are using some more advanced ESG integration. So in a way, do you think it is possible to kind of measure somehow in a comprehensive and not least misleading manner, I would say, yes, I mean, in investments that might be using different sustainability related strategies, and also some being more kind of outcome focused, but also, for instance, some investing in what is already kind of green, right? And here the value added being you provide capital, but then of course there are also discussions, okay, on, is it new capital, right? Is it through the IPO or secondary offering or private equity, or is it just, I would say, on the secondary markets? And then, for instance, in a way also, how can you exactly compare or measure it against, for instance, more typical impact investing or transition finance, whereby, for instance, some investors might be leveraging on the stewardship and engagement, right? To kind of like engage the company and help it, I would say, on the kind of journey towards sustainability.
Yes, actually, that was part of this idea of make it more clear categories where we distinguish the categories that we feel as. So at the top, you have 7, 6, 5. They're probably more related to really be trying to have an impact, being closer to Article 9. They really would still disclose and track their proportion of what they call sustainable investments, whether they use the taxonomy for it or the SFDR Article 2 definition, and then a range of categories below the 5. So you have 4, 3, 2, that basically consider different, more ESG-like strategies, where there is room, and they should disclose if they do exclusions, if they consider pies, but they do not necessarily track the proportion of sustainable investments. That's not their key characteristic. And some investors, for some clients, that's enough. They would like, but it needs to be very clear, and it would help if it's more differentiated from the more outcome or impact-driven categories, who may differ in their percentages of sustainable investments. There's also room for different providers. And we offer, as Triodos, we have, we only do Article 9, but both for listed assets, listed equities and bonds, as for private assets. We do private equity, just that to in developed markets, emerging markets. We have project equity in the energy transition. So we have quite different asset classes, and we think that would work for all the funds and making it easier to compare. But of course, it really differs if you have a private equity stake in an energy transition company or in an organic food company because you want to spur the food transition, for example, and to compare that to a listed just corporate bond. So it will always be hard to compare, and people need to be aware of the differences in the asset class. But we think with this categorization, it could help actually to make the comparison easier.
Okay, very interesting. And speaking of retail investors and make it easier for them, would you have ideas, for instance, for the category denominations, names that could be easily understood? Because, for instance, in particular, speaking of transition actually investments or impact investments, there have been so many discussions, in a sense, transition towards what, right? I mean, we use it kind of on continuous basis, so we kind of know what we mean by that, but it might not be necessarily easily understandable for, I would say, financial services consumers, right? I mean, also, for instance, with regards to impact investing, I mean, some people raise that there are so many diverging definitions. I mean, have you considered what, for instance, category names could be, appropriate and at the same time easy to understand for retail investors?
Yeah, I think the honest answer is no. We came to the 1 to 7 to make it more objective. We think transition assets can be included. The taxonomy clearly allows for doing that. Our statement would be that if you claim to do that, if you invest in transition assets or companies, that's fine, but it should be accompanied by these additional disclosures of their net zero trajectory that we discussed before. Because transition assets and just saying, okay, this is transition assets and that's it, we know it's not enough. More is needed. These transition plans need to be implemented. And if you invest in these companies, you need to be on top of that as well, that's referring to our earlier discussion, why that's so important. So no, I think, well, we should see if someone can come up with good names. We felt quite comfortable actually with the numbering 1 to 7 to make it a bit more objective, have clear criteria, and there is room for these transition assets as long as you have these additional disclosures of the net zero trajectories that's then behind that transition asset.
Okay, thank you. Very insightful. What are your views on the principal adverse impacts and their consideration? Do you think this is a provision that should be retained? And if yes, do you think it should be retained both at the entity and product level?
Yes, we think they should be retained. Already the number of work that the amount of work that went into it. And mind you, it's definitely easier on the listed side as on the private side. We didn't touch on the topic of data for SME companies, impact bonds, emerging markets, but that's always mentioned when it comes to SFDR, so people know, but that's quite a challenge. But even though it's a challenge to gather the data, and it will take some time to get these pies really on good quality level, data quality level for the private markets and emerging markets as it is on the listed market already. But we think they should be retained. It's actually quite impactful to, of course, we did it ourselves. We looked at the buy statements and you clearly see, particularly if you benchmark them a bit, that in our case, you have less risk in your portfolio. So the investment thesis gets demonstrated in the PI indicators. So that's a good thing to keep. And it's clear. And this whole podcast is about the importance of demonstrating and being aware of your negative impact. So the PIs are doing just that. We would like to see PI disclosures on product level, though. We think that's more insightful, and you have to have them anyways in order to make an entity level. But entity level is a bit generic, and it's better to have them at product level. And as I stated earlier, we think the PI disclosure should be mandatory for all products, and not only the ones that consider themselves sustainable, yes or no. But that's really in order to have that level playing field. Maybe then the set of indicators might be a little bit more limited. I think if we make it mandatory for all, it should be, particularly on environment and human rights, of course. So that might be a bit more limited than the ones we currently have. But that would be a big improvement if it's for all products, more on product, but keep them in.
Excellent. Well, thank you so much, Hadewych, for joining us today and for this very insightful conversation.
Likewise. Thank you, Alexandra.